Hello, everyone, and thank you for joining us today. My name is Adina Ostad, and I'm happy to be chairing our Financial Literacy Workshop series being presented by UJA-Federation and Commonpoint Queens. It's nice to be here with all of you. And while we can't physically be together or even see each other right now on Zoom, I know I speak for all of UJA Long Island women, chaired by Pam Barnett and Commonpoint's leadership, when I say how so grateful we are for the chance to gather virtually, to be able to connect over timely topics and be in community together. Before we introduce our featured speaker, I'd like to share a few words about UJA's work in these challenging times and acknowledge the moment that we are in. As we all know, it's been 11 months of living with uncertainty. And while we are so grateful for vaccines and the medical breakthrough they represent, there's still a long road ahead. More people are dealing with food insecurity. More are unemployed. More are worried how they're going to make ends meet. And we need to be there for all of them, as we have been from day one of the pandemic. I know we all wish we could fast forward to the end of this crisis, to a fully recovered economy, to us all gathered together in a room. We're not there yet, but UJA has the ability to meet unprecedented challenges. They've allocated to date over $64 million in grants and loans over and above their normal allocations to support COVID emergency relief. At this time, we'd like to play a short video that tells that story.
In this time of tremendous need and uncertainty, UJA has been on the front lines, allocating $64 million in emergency funding. We continue to source hard-to-find PPE and critical medical supplies for healthcare workers across our community.
With UJA's support, we don't collect concerns, we act on them.
As COVID continues to devastate our city and our community, the demand for food has more than doubled.
We increased our ordering so that no pantry and truly no individual would be without food when they needed it.
We want to keep our grandparents, our Holocaust survivors, our people with disabilities, we want to keep them as safe as possible.
On October 6th, we cut the ribbon on our new hub in Queens, a one-stop social service center that will help tens of thousands of overwhelmed New Yorkers find jobs, access nutritious food, and receive support from caring professionals.
Without the flexibility that UJA provides us, agencies like mine would be in real trouble.
We're providing the funding needed to guarantee that the vital institutions that New Yorkers rely on can survive. With innovative after-school programs and daycare access, we make it possible for thousands of struggling families, including essential workers and single-parent households, to keep going. And our reach extends beyond New York. We're there to help wherever we're needed, in Israel and around the world. And as the pandemic continues, there's hope.
We now know that the vaccine is here. We're working really hard to coordinate with local elected officials to make sure that New Yorkers get what they need when they need it, no matter what.
Unbelievable. It just can't put in words what the UJA is doing.
We couldn't do this without UJA.
Thank you so much for all that you do, and thank you so much for taking care of my little girl.
We're building an even stronger, more resilient, more connected New York. And we can't do it without you.
Wow. Thank you to all of those who have stood with UJA to make all this possible. At this time, I'd like to turn it to Leslie Kraut from Commonpoint Queens.
Thank you, Adina. Good afternoon. I'm Leslie Kraut, one of our social workers here and director of our single parent program at Commonpoint Queens. Commonpoint Queens is a community center dedicated to sustaining and enhancing the quality of individual, family, and communal life throughout the greater Queens area. We are a UJA-funded nonprofit and without meet their challenges caused by the pandemic. Through our kosher food pantry, our walk-in employment and social services hub, peer support to seniors, counseling, and various other programs we continue to serve. While times are tough, we're also amazed at the resilience of our community, and we know that knowledge is power. For that reason, we've partnered with UJA to create this basic personal finance series for women. This is our first of a 3-part series. Our presenter today is Aviva Pinto, Managing Director of Wealthspire Advisors. Today's topic will be saving and budgeting, bank statements, credit, and debt. We are pleased to introduce you to Aviva Pinto.
Thank you so much, Leslie, and thank you, Adina, and it's a pleasure to be here. And I am going to share my screen, and we will bring up the slides for the presentation. And this is a financial literacy course, which basically means that I am not assuming that you know anything. So it's for beginners, it's for people who can learn a little bit more, and I hope that everybody will get something out of it. Now, first for disclaimers, and these are not legal disclaimers, these are disclaimers of how you should feel while taking this workshop. First of all, we are not born financial geniuses. We're not taught financial literacy in school. A lot of us aren't taught finances by our families, and there's nothing to be embarrassed about. I'm not very good at a lot of things. Like I need to ask my kids for how to use this phone sometimes and the apps and how to record things on TV. Everybody is skilled in a certain area. And what we all have in common is that we can learn. So there's no judgment today. We're all here to learn. Some things you know, some things will be new. And by the end of this 3 sessions, I hope you'll have learned something to help you take control of your finances for the future. And there are no dumb questions. So please, if you have questions, we'll have time at the end. Please put it in the Q&A and we'll get to them. So let's start with basics. What is a budget? So a budget is just a plan that shows where you're bringing in the money and where it's going out. It tells you how much you have, how much you can spend, and how much you can save each month. And we're going to talk about savings next. It allows you to keep track of your spending habits. And with technology, it's easy to create budgets with the help of websites and phone apps. So you can see exactly where your money is actually going and help keep you on track. So how do I make a budget? You start with how much you're making for the month. So let's assume you make $1,000. Next, you list all the expenses that you have, and the common categories are things like your mortgage payment or rent, and we'll discuss mortgage in the next session, so we'll get to all that. Car payments, which we're also going to talk about in the next section. Insurance, like your health insurance, life insurance, car insurance, the groceries, when you're eating out, when you're taking out, when we go back to eating in restaurants, your utilities, cell phone, gas, electric, water, internet, cable, entertainment, personal care, getting your hair done, getting your nails done, childcare, transportation, whether you take the bus or the subway or a taxi or an Uber, parking, gas, tolls, all of those. When we go back to traveling, any clothing that you buy for yourself, for people in your family, and then student loans. And the best place to get all of this information would be bank statements, and we'll talk about that next, and receipts. If you just collect your receipts every time you go out and shop from the grocery store, etc., and put down that number on a piece of paper, you'll be able to start figuring out how much you're spending. So let's do a few examples. Let's assume that we add up all the expenses from the categories we just listed, and we find that we are spending $1,100 a month. Now, we said that we're making $1,000 a month. So in that case, we're spending more than we're making, because 1,000 minus 1,100 is negative 100, and you're going to be in debt. And we're going to discuss debt next. Now let's assume that we add up all the expenses and it comes out to $900 a month. Well, in that case, you're spending less than you're making and you can save. And we're going to talk about savings. So 1,000 minus the 900 that you're spending, you've got $100 to start saving. So why should we save? So mainly you save so that you can have peace of mind. This is the money that you can dip into when you have an emergency, like the air conditioner goes out or your you crash your car and you need to replace it, or you have to buy a ticket for an unexpected trip home to visit elderly parents or something like that. And you can divide your savings into different categories. You can save for your house, you can save to fix things up, you can save for your kids' college, you can save for a vacation, you can save for the future for your retirement. I like to have clients put down what their savings goals are. And if you've never saved before, think about it as putting money aside for something that you desire, a new pair of shoes, takeout food, a future vacation, whatever it is. You're working towards a goal, and you need to understand that there's a lot of value in paying yourself first. So start with a little bit. It could be as little as $5 or $10 a week, whatever you decide to put on the side. And then you can increase the amount you save per week until you have your initial goal, and it's easy and achievable. So obviously, savings is an important aspect of maintaining healthy financial situations, but it's easy to ignore things like retirement because it seems like it's really far off in the future. So learning to save to help you gain knowledge will help you figure out how to put things in short-term, medium-term, and long-term goals. So now we have that $100 or the $5 or $10 we're putting aside a week. Where do we put it? Do you keep it in your cookie jar under your mattress, or like my grandmother used to do? She would tuck it into her bra strap. There are a few better places that you can put it, and you can even earn money on your savings. So my suggestion is to open an account at a credit union or a savings bank. So what is a federal credit union? Credit unions are owned and controlled by the members who use their services. So they are not a for-profit organization. They only operate to help their members, and each member is a part of the credit union. They even elect their own board. And what happens here is that people pool their resources to help one another. So if I put my $100 deposit in, it can become another person's loan. And all the profits that are made are given back to the members in the form of lower fees, higher savings rates, and lower loan rates. So they're safe, they're affordable, and it allows people to pool their funds. So you may be asking, can I join a credit union? So you can join based on a number of things. One, your job. Many employers sponsor their own credit unions. So you should ask your employer whether they're part of one. Family members. If you have another family member who is in a credit union, they will allow other members of the family to join. Where you live. Many credit unions serve people that live or work or worship or attend school in a particular geographic area. And then there's groups that you can belong to. So membership in groups such as where you worship, or the school, or your labor union, or a homeowners association may qualify you to join. So you can look up credit unions. There's a website called mycreditunion.gov. And we will be handing out copies of these slides afterwards. So if you don't write everything down as I'm talking, and I realize I'm talking quickly because we have a lot to get through, you can refer back to the slides. So what's a bank and how does it differ from a credit union? Well, the main difference is that a bank is a for-profit institution. So they are collecting money and trying to make a profit for their shareholders. Anybody can be a customer, but they will have higher fees and interest rates on loans because they're trying to make a profit for their shareholders. And they may have a larger array of products than a credit union. The deposits are insured by the Federal Deposit Insurance Company, while credit unions have the National Credit Union Association insuring their deposits. Both are very safe, but credit unions really are to pool money for members to help members and not for profit. So we have our $100, and let's say we're going to put it in the credit union. So what happens next? Well, we open a savings account. And what is a savings account? Savings account is where you store money and you earn interest on that money. What is interest? So if you're a saver, the interest is the money that the credit union or bank is going to give you for keeping your money with them. You are earning interest because the credit union or bank can use your money to lend to other people. The higher the interest rate, the more you'll earn on your savings. So let's look at an example. Let's decide we take that $100 a month that you had left over from the budget example, and we deposit it in the credit union. Right now, most credit unions are paying an interest rate of 0.5% or 0.50. And what that means is that at the end of the year, if you had not put in any more money, you just had that $100, your balance would be the $100 plus the 0.5% interest that you earned from the bank, or $100.50. Now, you're thinking that doesn't sound like a whole lot. Well, what if we assume that you put in $100 every month? And at the end of the first month, you're going to have your 104 cents, okay, because you have your $100 plus your 0.50, 0.50% interest rate, but you have to divide by 12 because we're looking at monthly figures, and the year is 12 months. They give a yearly rate from the bank. So the 0.5% is a yearly rate. So we divide by 12, and at the end of the first month, you have 4 more cents in the bank. Now, the next month, you add another $100. So you'll have the $104 from $100.04 from the first month. And then you will have your $100 times the 0.5% interest rate divided by the 12 months, and you'll end up with $200.80. The third month, same thing. You have your 280 cents. You add on your 0.5% interest for the month. You end up with $301.20. This is what we call compound interest. So instead of just having $100 the first month, another $100, and another $100 for $300, you've actually made $1.20 by the third month because it's paying you interest on the interest. So it pays money on the deposit plus the interest from the month before, and so on and so on. So if you were to save $100 a month for a year with interest rate of 0.5%, at the end of the year, you'd have deposited 100 times 12 months, which would equal $1,200. But because of compounding interest, it brings your total to $1,304. In 2 years, you would have $2,514. In 3 years, $3,730. 4 years, $4,952, and 5 years, $6,180. So as you can see, just saving $100 a month and having it pay interest can accumulate a lot of money over time because you're earning money with your money. So if you save more a month, you can accumulate more savings faster. So if you can save, for example, $200 a month at 0.5% interest instead of the $100 a month, you'd have $12,359 at the end of 5 years. Now, if you need to take the money out, you can always take it out. They call it withdrawing, but because it's a savings account, you're less likely to spend it if you're putting the money in there. So now let's talk about what other accounts are in banks and credit unions. Checkings accounts versus savings accounts. So a checking account is used for payments. It's best for money that you plan to spend soon. It does not pay you any interest. So instead of putting your money under the mattress or in your bra strap, you put it into your checking account so that it sits there so that you have it and it's safer than having it under your mattress. Savings accounts are used to save for the future. It's good for money that you don't need right away because it's paying you the monthly interest on the money that you deposit. So a checking account is holding the money for you. You write checks, withdraw the money from an ATM, and I'm going to get to that next. Savings account, you save, pays you interest, and you can grow your money over time. So ATM. A lot of people know what this is. There are many people that do not. So I'm going to quickly run through what an ATM is. It stands for automatic teller machine, and it's the machine you see when you drive or walk up to a bank, credit union, gas station, grocery store, convenience store, and it's also at the branch of your bank or credit union. And you can withdraw money from your checking or savings account without any fees if you're taking it out of the branch of your bank or credit union. If you're taking it out from a gas station or a grocery store or convenience store, they may charge you a little bit of fee. So make sure you read about that before you take the money out. So they look something like what I have up on the screen, and they have a screen on top where it shows you the options of what to do and a slot where you can put your card in and you can key in your information underneath it. So to use the machine, the bank will give you a debit card. Now the debit card is attached to your checking account or savings account. And it'll be an account number that you pick a password for, a combination of 4 to 6 numbers, and you put it into the machine. And the number that you pick, the password, is called a personal identification number or PIN number. And it'll have words on the screen asking you in whatever language you want. Most ATM machines have multiple choices: Spanish, French, Farsi, Chinese, Japanese, etc. And it will talk to you in your own language of what you want to do. And when you see the screen, it'll ask you whether you're depositing money into your account. It'll ask you whether you're taking money, withdrawing money out of the account, and you will press the buttons and it'll show you what's going on. Now, the most important thing is that you can only take out what's in there. So that if you, I went ahead too far. So if you put your $100 in and you want to take $40 out, there's going to be $60 left in there. If you have $100 in there and you ask for 110, it's not going to give you that because that's not in there. So it's a great way for people to control themselves because you can only take out the amount that's in there. I think this is wonderful for kids because if they can learn that they have a certain amount in there and they can't spend more than what's in there, you can teach them how to budget for the month. So now let's talk about paychecks and managing your account. If you're employed, you receive a paycheck. They can be very confusing because there's lots of different acronyms and words on it. So most of the paychecks will show you gross earnings, which are earnings before they take money out for deductions, and we'll go into what the deductions are. Net earnings is what you take home. It's after all the deductions are taken out. Your current pay is what you're getting for that week. YTD is year to date. BEG shows the beginning. REG shows your regular hours that you're working. OT is overtime. HOL, holiday hours. VAC, vacation. I'm going to provide these slides so you can look through all the terms that they use. So this is an example of what one of your paychecks could look like. And what it shows you is your name, the time period, how much they're paying you, and the deductions that they're taking out. Now, the deductions are taxes, which we're going to get to in the next session that we do. It's going to be anything where you have asked them to take out money for transportation or for health insurance that the company is paying for you. And then it's going to show you what the net amount is, which is the amount that you take home after they've taken out all the deductions. And if you're working at a company that pays you by check every pay period, you can ask the money to be deposited straight into your account or the credit union, and that's called direct deposit. So the money from your paycheck goes directly into your checking or savings account. And some people find that if they don't actually have the cash, then it's easier for them to save because it's going directly into their bank and they don't have the temptation of spending the money. The other thing that you can do is that you can have electronic bill pay set up. So instead of walking or sending your rent payments to your landlord each month, if you have a checking account, you can set it up to automatically pay for whatever it is each month. And that money will be taken from your account each month, sent to the account of your landlord. This works best for bills that are the same amount each month. Now, if you have a cell phone, you can set up different accounts or a computer. You can set up different accounts that you have to pay each month that have different amounts. So for example, the electric bill. The electric bill is not the same each month. One month you're going to use more electric, say in the summer, and other months you're going to use less electric. So for that, you can put into mobile banking and you can set up bill pay directly from your checking or savings account to the account that's asking for the money. And this works well with accounts that the amount vary from month to month, but because the money stays there and it's not in your hands, it's easier to keep it there until the bill comes due and then have it transferred. So now every month you're going to get a statement from your bank. And this is a sample from Bank of America that shows you the beginning balance. It shows you everything that you added to the account. It shows you the withdrawals that you took out from the account. It shows you any of the bill pays that you made directly, and then it will itemize it at the bottom so that when we're doing the budget and you can take a look and say, oh, you know, I paid so-and-so this much on that day, you can put in a monthly budget and keep track of it by using your bank statement. So now let's move on to credit and debit. And we're covering a lot of information, but we spoke about debit cards when we talked about the automatic teller machine. The card that the credit union or bank gives you is a debit card. So the money you can put in or take out, that card can only spend, as I said, the total amount in that account. So once you take the money out, you can't take any more unless you put more into it. A credit card is different. A credit card is similar to a loan. You're going into a store, you want to purchase groceries, and the groceries total $100. You give the cashier your credit card, and in effect, the credit card company is lending you the money to pay for those groceries for a month. And at the end of the month, you have to pay the credit card company back the $100, or they're going to charge you interest. Now, it's the same concept as the interest that the credit union or bank paid you for lending them money, right? But in this case, they're lending you the money, so now you owe them interest. And if you don't have the full amount of $100 to pay back for the groceries at the end of the month, you can pay a partial amount and you can pay interest on the rest. So let's say you have $50, but you spent $100 on your credit card. You can pay them the $50 that you have and owe them the $50. Now they're going to charge you interest on the $50 that you owe. But unlike the 0.5% that you received from the credit union when you deposited your $100, the credit card company is in it to make profits, and they're going to charge a lot more in interest. So currently, credit card companies are charging a whopping 16% in interest annually, or approximately 1.3% monthly. Credit card interest rates are quoted as a percentage, APR, which stands for annual percentage rate, and it's what they charge for 12 months or a full year. So if you owe $50 and you don't pay them back at the end of the month, you actually have to pay them $50.66. If you don't pay them for an entire year, the same $50 will cost you $58. So if you have an $1,000 balance for the entire year, you'll have to pay them $1,160. So you can see that they're making a lot more money lending to you on your credit card than you'd be making from your bank in your savings account. So if you decide, you're going to move forward, you're going to be really responsible, you're going to pay at the end of the month so you don't have to pay those exorbitant rates, how do I choose the right card? So you need to understand your options for spending habits and credit situation. The first step is to check your credit score. So what's a credit score? If you have a credit card in the past or have a car loan or a mortgage, you will have a history of how you've paid your bills, and that will determine your credit score. You are entitled, federal law entitles you to a free copy of your credit report from each of 3 different bureaus every 12 months. And you can get it at annualcreditreport.com, which is a federally authorized site. So let's assume you have good credit, all right? Or you don't have any credit at all. There are 3 general types of credit cards. The first is a credit card that helps you build your credit or improve your credit if your score is poor. They have student credit cards, and those are meant for college students who've never had credit. They're easier to qualify for than other types of credit cards. So are secured credit cards, which generally require a security deposit of $200 or more. Your deposit will be returned to you when the account is upgraded to a regular credit card and closed in good standing. So for people who never have credit or have poor credit, think about whether you're a student, get a student credit card, and if you're not, look for a secured credit card. And you can have cards that save you money on interest. So if you want to save on interest, the low interest 0% rates or balance transfer cards are best. And the card normally has a 0% introductory rate and an ongoing low interest. So this card is good if you plan to use your credit card in case of emergencies, or if you have a regular income and carry a balance from time to time. The balance transfer offer can help you pay off a high interest that you have on other credit cards debt-free, but you need to make sure that you know when this ends. So let me go back for 1 second. The 0% lasts for a certain amount of time. And when that time is over, it will reset to a higher rate. So make sure if you get a 0% balance card that you make sure that, oh, I skipped ahead rather than back. I'm sorry about that. You make sure that you ask when it resets. And finally, there are cards that earn rewards. And a rewards card is a good match if you pay off your balance in full every month and never incur interest. And these cards typically have higher rates, but because you're paying it off, it doesn't matter. But they're offering large sign-up bonuses and give you points, miles, or cash back on every dollar you spend. So this is really good if you pay off your balance every month. So the questions to ask when you are looking for a credit card is, will this card help me build my credit? How much is the annual fee? If you have very poor credit, you need to make sure that if they're going to ask for higher fees because they don't think you're going to pay it back on time. If you have very good credit, then you look for cards with low annual fees. You want to see if you can move up to a better card later on. And as I mentioned, if you get a 0% card, find out how long the 0% lasts. And once you have your credit card, use it wisely. Don't just pull it out and spend. Carefully monitor your spending so you don't find yourself with a huge balance at the end of the month that you can't pay back. Remember, you have to pay it back at the end of the month. And if you're trying to establish your credit, pay your bills every month on time, and you'll have a much better credit scores. So credit can be a very useful tool if it's managed correctly, but making rash purchase decisions is going to be costly. So make sure you understand you have to be responsible. And the credit card you choose should help you achieve your financial goals in the most affordable, efficient way possible, whether you're trying to build credit, borrow money, or earn rewards. So we have covered a ton of information in a short amount of time. I am available for questions if we don't get to it after this. But I thank you for your time. We're going to turn it over for questions now. And if anybody needs additional information, please reach out to whoever invited you on at Commonpoint Queens or UJA, and I'll be happy to help. Thank you so much. I'm going to stop sharing my screen here. Okay, and we're back. Adina, Leslie. Hi,
Thank you so much, Aviva. That was a very informative first session. Looking forward to our second session on February 23rd. A very special thank you to Leslie as well from Commonpoint Queens, and of course, Barry Ziegel at UJA. Thank you to everyone who joined us today. And again, looking forward to seeing everyone on February 23rd for our second session. Thank you.
Thank
Bye-bye.
you, Adina.